one of the big things as an active real estate investor is you run into where you're doing so many deals, excuse me, where you're doing so many deals and all of a sudden the bank stops funding you, right? You start running into trouble with getting financing. And that's where you kind of run into, well, I got to slow down my business, or I got to stop doing as many deals so I can win in the banks. And that goes back to that original quote we talked about with, it's not about your actual resources, it's how resourceful you can be. So have you ran into that problem in your business, Devin, where you kind of, the banks were stopped lending to you? Is that one of the reasons you went towards private money, or what are the reasons you kind of went towards private money, would you say?
No, I don't have any problems with the bank lending me money because we go through my wife. She's W-2, super bankable. So W-2s are generally just a pay stub and a W-2 you have to provide. And she's got great credit. We don't have a lot of debt, so we don't go out and buy Ferraris and finance them and buy dumb stuff. So our debt to income ratio is low. The reason I started using private money is because when I fix up properties, I'm doing it with short-term money. I'm not buying it from like a mortgage lender up front. I'm buying it from a hard money lender. So that's higher interest, but they don't look at me personally. They look at the asset. So they'll lend based on the property. So I'll buy it with hard money and then I'll renovate it with private money. I do that because I don't want to use my own money. If I use my money, I'm limited on one, how many deals I can do, and two, the amount of return I get, because all of my money's in the deal, my returns are going to be lower. So I just try to use other people's money as often as possible, which is really why I think that real estate is probably the best vehicle to build wealth, because you don't have to use your money. I've done deals where I've literally used $0 of my own money, not one penny. And if you make just $1 off that property, you have an infinite return. So it just makes sense to use that leverage.
Yeah, no, absolutely. And, there's, because I get asked that, sometimes like, well, if I can go, somebody can go to the bank and get a loan for 5%, why would they pay 12 to 15% for private money, right? And so I get that question a lot. And, so that's your reason why you're doing it, to keep your money out of it. It's for the short term, the gap funding, things like that, which makes a lot of sense. And then you're taking advantage of the bank's cheap money for the long term, locking in those 30, those fixed rates for the long term, which is very, very smart. Chris and I have talked a lot, and one of the reasons he went to private money when they were doing, lots and lots and lots of flips in their business was because the banks eventually, you just get to that debt to income ratio where they don't want to lend you anymore. You're already overextended. They're already lending you so much, and, you're doing multiple homes at the same time, and they finally just say no. So at that point, a lot of times real estate investors are forced to go over to the private market and start doing hard money and private money and things of that nature. Some of our larger investors, we have that do larger projects. So for instance, we just did a raise in the Private Money Club. It was a $10 million raise for a new home development rental community that's being built right now from the ground up. And he's willing to pay anywhere from 12 to 18% for that money. And he has access to bank money all day at 6%. So people are like, well, why is he paying double or triple for the private money through the Private Money Club when he has the other financing secure? And for his case, it's just the ease of money. It's very easy to get private money, and he can get it when he needs it. Because a lot of times with private money, you don't need private money for 5 years. You know what I mean? And a lot of times banks want to lend to you for 5 years or a longer period. They don't want to lend to you for 6 months and get their money back. And if they do, they want a whole lot of points on top of it, right? So what points are, guys, is just a 1 point is 1% of whatever is loaned out. So on $1 million, it's $10,000, whether or not that loan's paid back in a day or in 5 years, those points are still on that loan. A lot of times in private money, there's no points, or if they are, they're very small, maybe on the back end, something like that. So somebody's willing to pay a little bit higher interest to just use the money for the short term that they need it, maybe 6-8 months, maybe a year. So they don't have to pay the shorter interest, but for a longer period when they don't need that money. So there's a whole lot of reasons why private money is used by real estate investors. and all types of real estate investors, everybody from, Devin that's doing the Airbnbs up through these larger, developments and multi-million-dollar projects like I'm talking about, and everything in between. And so the private money is very, very important when it comes to real estate investing. And that's where becoming a private money lender becomes so valuable, and why these borrowers, want to join things like the private money club and want to go out there and meet lenders, and because they need that money. So it again creates those win-win situations. If you have the money and you're just looking to grow your money, but that's protected by a hard asset at a decent interest rate that's predictable and consistent, private lending is a great way to do that. And if you're actively going out there making the big bucks doing the active real estate, you need that private money to get to do more and more and more deals. So it creates those nice win-win situations that we always look for when it comes to business and when it comes to investing.
You made a great point, Stephen. Like, private money is a great way to invest if you just want really just passive income where you don't have to do anything. Like, you can just give your money to someone and get a return based on a hard asset. Like, whenever I borrow private money, it's tied to an asset. It's tied to a property. And I am super, super conservative when I purchase properties. So there's always a lot of equity in the property. For instance, I have one right now that I bought for $520,000. I could literally wholesale it right now, not do a thing to it, for like 750. I got it really, really deep. Once it's done, it's going to be worth about 1.2. So there's not really that much risk, because if the market drops, it's still going to be in a good position with equity. So if you lend on the right kind of deals with the right people that have a track record, that know what they're doing, you've got a very low risk investment where you don't have to do anything. You just get checks in the mail. I'm literally writing checks. Here's one right here. This one is to one of my investors. Not sure if you can see it. It's $1,250. So this one I have to send out today. This is just $1,250 that they get every month from me while the property is actually being, while it's under construction and while we're actually getting it up to snub. So that's easy money. And I've got other investors, one where I'm sending $1,800 a month, just sending them money every single month. So super easy. People always ask me why I don't do it. And realistically, guys, you have to weigh your skill set. Like, I have this skill set where I can go do Airbnbs and make ridiculous returns. Let's say as a private money lender, you make 15%. That's pretty dang good for not doing anything. But I can go do a real estate deal and make 10,000, 15,000, 20,000% returns because I have that skill set and that knowledge. So it wouldn't make sense for me to lend money because I can make so much more doing the deal. But if you don't know how to do it, it makes a lot of sense just to lend your own money and make 15% with very little risk.
Yeah, I mean, that's absolutely right. I mean, the money's in the big money's in the active real estate investing, but that requires time. And there's a lot of people out there that just don't either have the time or have the wherewithal to go out and learn the skills and do it on a daily basis. There's nothing easy about active real estate investing, whether it comes to flipping, wholesaling, Airbnbs. It ain't easy. There's the stuff that always goes wrong, and it's always a challenge. And so that's why you make the big bucks. But if I can lend my money to you, Devin, because those people you're paying those checks to, are they happy about getting that money in each month?
I'm sure when the check comes, they love seeing it.
And what are they doing to earn that money each month? What are they doing?
They do nothing. Like literally nothing. Like up front, there's a little bit of work because you have to go through escrow. So you have to provide documents and stuff like that. And we have to sign contracts. But honestly, that takes, what would you say, Stephen, 5 minutes?
Yeah.
Like that's it. So there's a little bit of work up front that needs to be done. And then you wire your money to the escrow company. And then you're just getting checks in the mail. It's literally that easy. And to your point, when you're doing active real estate, there is kick to the face after kick to the face. Like with social media, people don't see this because social media is basically a highlight reel of everyone. No one puts in all of their struggles and all of their setbacks. You just see, oh, hey, I'm in France. Oh, hey, I just bought this property. Oh, hey, I just made 300 grand. You don't see all the struggles that go into it day in and day out. Like, we just had a property that got broken into, and we got all of the TVs stolen and all like the expensive stuff in the house. $6,000 worth of stuff stolen. That's a kick to the face. If you're just lending money, you don't have that kick to the face. So it is not for the faint of heart when you're actively investing in real estate, without a doubt.
So when I say I'm lending my money to Devin and he's paying me 12%, let's just say 12%, we'll take the average, right? He's paying me 12% annual returns on my money. Well, what that means is that's 12%. The interest payments are going to come in monthly. So that's basically 1% a month that you have coming in passively. So it creates a nice income, but 12%, while it's a nice, consistent, predictable return, 12% is a very good return when it comes to investing, especially passive investing. It's not necessarily going to make you rich or get you super, super excited, right? But what if I can show you how to do nothing different and make 44% on that exact same deal? Does that sound a little bit better? Would you rather make 12% or 44%, Devin?
I'm not really a numbers guy, but I think 44 is better than 12.
So here's the thing is all we're going to do here to accomplish this is we're going to take advantage of the infinite banking concept. We're going to change where our money is going first. So instead of this money that I'm lending to Devin coming from my savings account or my checking account or my business account, it's going to come from my own personal banking account, my own personal bank, which is my money multiplier policy account. Okay. So let me show you how this works. So this was a policy that was a 41-year-old. And what they did is they decided in the 8th year of this policy, they were going to do a private money loan. So first off, in the 8th year of this policy, they were able to put $48,000 into it, and it grew by $66,000. So that policy grew by 37% that year. That's a tax-free return just from them putting their money into there. Then what they did is they borrowed the money out of this policy and they gave it to, let's say, Devin in this example at 12%. So this is all very passive. So they just put 50 grand into $48,000 into the policy. That took, I don't know, 2 minutes to input their bank information and send the money to the insurance company. They made a 37% cash on cash return on their money just like that. Then they took a loan from the policy that takes about 1 minute to do. So another 1 minute we're in. They lent that money to Devin. Devin, you said that takes maybe 5 or 10 minutes to lend to you. They made 12% on that money. Now remember, they're paying 5% to the insurance company for borrowing the money. But if we add up the 37% return plus the 12% they're getting from that money loan to Devin, we just created a 44% return on our investment that year on our money that we would have otherwise just made 12% on. And the only reason was that is because we followed the infinite banking concept and we were able to change where our money is being held and warehoused in our own bank instead of a traditional bank. There's nothing else. We didn't take on any more risk. We didn't spend any more time. We didn't work any harder, but we turned a 12% gain into a 44% gain. It's as simple as that.
You know what's crazy is that's amazing, right? Just by changing one step, you can go from 12 to 4 or 12 to 44. It's actually much higher because if you understand the infinite banking concept, your money's not being used. Your money's sitting in the policy. The only money you have being used is the 5% interest that you're borrowing. So you're basically turning 5% into 44%.
Right.
So what's that return? That's almost 1,000% return.
Right.
That's crazy.
It really is. And just to show you guys just one more example of really how easy this really is. I mean, so this is what we call like the circle of moving money when you're using your money multiplier policy to invest. So just to show you, I mean, the money starts in the money multiplier policy. We take the loan, it goes into what we call the segregated bank account. So the segregated bank account, again, is just a separate checking account that we use in conjunction with our infinite banking policy, just for accounting and tracking purposes and to keep up with what the money's doing. So the loan comes from there into that segregated account, and then immediately, in this case, goes out to that private money loan based on a piece of real estate. In this case, we found the deal using the private money club, which I'll show you guys in just a second. Then the deal in that private money club, like we've been talking about, sends out those monthly interest payments to the investor, like Devin was just showing a second ago. So that money goes back into my segregated bank account. And from there, I keep the spread. So any of those profits from that 3 to 4% I was paying to borrow the money to the 12 to 15% that Devin's paying more, that's all profit right there. And then the leftover spread just goes right back into the policy. So I can do it over and over and over and over again. And again, we're not even using our money right there. We're just borrowing it out. So those returns really become very, very powerful. So when you're on the private money club and you start looking at deals, what I always like to do is I always like to start with the person. The person's experience is big, because if you can trust the person, then no matter what happens, you know that they're going to be there to take care of you. You know that they're going to be there to be able to, pay you back, that you're going to get your money back, because they have different outs. They have different exit strategies. Or if it's somebody that's newer to borrowing, a newer investor, I'll still look at working with them, but I might expect better returns. Maybe I want 15, 16, 17, 18% returns on my money. Maybe I want to charge them some points. So you can start negotiating a little bit what that looks like and what that contract looks like. So it creates a win-win situation for the lender and the borrower. And so let me show you an example real fast of a private money loan, okay? So I mentioned earlier that there's different places where you can have your money, okay? Whether it's in a retirement account, whether it's in a privatized bank, whether it's in cash or at the checking account, whatever the case might be. Well, let me give you an example of a private money loan through a money multiplier policy, one of those specially designed and engineered whole life policies. So this is what you see on the screen right here. Right here is the policy, okay? So this is where my money flows. So instead of my money flowing into a traditional bank, my money flows into my own bank, known as my money multiplier policy. Then what I do is I pull the money out of there. When I take the money out of my policy, I'm going to pay the insurance company anywhere from 3 to 5% interest, depending on the company. That money goes into what we call a segregated bank account, which is just a brief holding place for the money to go from my policy to go to wherever it needs to go. In this case, it's going to a loan to somebody that I met within the private money club. Let's say this is John and Lori Halter. Okay, they were paying 12% on their deal. Or let's say this was Jack Petrick. So my money goes to them. Now they're going to pay me monthly or quarterly, or in Jack's case, a couple lump sums of money. So as that money comes back to me, I'm going to take it. I'm going to pay back the interest to the loan. And then all of that profit is going to be, or all that spread is going to be profit that I keep. So this is exactly how banks work. So when you take your money and you give it to the bank, they're going to pay you, let's say 1% in a savings account, but then they're going to lend that money on a mortgage to somebody at 5%. And then they're going to make that 4% spread. And then they lend that money on a car note at 8%. Now they're making that 7% spread. So that's what we're doing. We're taking our money out of our policy. We're paying 4% for it. We're making 12%. So we're making an 8% spread on our money. The only difference here is that the money within this policy is also simultaneously compounding tax-free, uninterrupted for the rest of our life. Does that make sense? So this is how the money flows when it comes to a private money loan, for example, using a money multiplier policy. So let's see what that looks like financially speaking. So this right here is what we call an illustration. So when you start a policy, you're going to get what's called an illustration on that policy, and it shows you everything about it. So this is with Lafayette Life Insurance Company. So it shows the name of the age of the individual, the year of the policy, how much they're putting into it. So these premiums are what we call deposits. Okay. So you're going to deposit money into your policy. Well, this person, they wanted to deposit $150,000 the first year and then $50,000 a year after that. And then you'll notice in year 11, it goes down. But so they start putting money in. Now, this is profit that they have from their real estate investing that they do. So think about it. That money has to go somewhere, right? So if you were to sell a deal right now and make $150,000, where would you put it if you didn't have your own bank? Well, you'd probably go put it in your business account or in a savings account, right? So it sits there and it's ready for the next deal. Well, this is exactly what they're doing. The only difference is their money's going into their own bank, their policy. So they put the $150,000 in and then $50,000 a year after that. You'll notice over here, they immediately have $132,000 available, and each year it just grows more and more and more. So let's say we're in the 8th year of this policy, okay? The 8th year of this policy, their policy grew by $66,000. To get that $66,000 of growth within their policy, they had to inject $48,000 into it that year. So when I put $48,000 in, my policy immediately grows by 37%, $18,000, 37%. So then what I'm going to do is I'm going to say, okay, well, I want to do a private money loan. I want to lend money to Jack Petrick at 12%. So I take $100,000 out of my policy and I lend it to Jack Petrick. Okay. And watch this. If I was to take $100,000 from my traditional bank account and lend it to Jack Petrick, I'm going to make a 12% return annually on that money. Watch this. By taking that money and lending it from my own bank, I not only get the 12% for the private money loan, but I got the 37% growth within my policy over that year. Now I paid 5% to use my money to Lafayette, but it still left me with a net of 44% return that year on my money. So let me ask you this question. What would you rather make, 12% or 44% returns on your money? We didn't work any harder. We didn't work any longer for this. We didn't take on any more risk. We just changed where our money goes first. Does that make sense to you guys? And in essence, that is what privatized banking is. That is why we are our own banks. That's why we do and become our own banks, okay? So these are all things that as you become a lender, you learn more and more about and you develop, what you like lending on. I know what I like lending on right now. What do you like lending on? So you'll develop what you enjoy as well. And that's the same with real estate, right? I mean, everybody's different. Some people love wholesaling. Some people love flips. Some people love rentals. Some people hate rentals. Some people hate flips. Some people like apartment complexes and developing real estate. And so there's different areas of real estate that you can do actively. There's also different areas of real estate that you can do passively. And you guys know what I mean by passive income, right? So for me, when I find a deal that I want to lend on, it might take me an hour. It'll take me an hour to look at the person, have a conversation with them, look at the deal, run the numbers, do my homework, and lend the money, maybe an hour. So to me, if it takes me an hour to do something that I'm going to get income from for the next 8 to 10 to 12 months to 3 years, that's passive income. Okay. I have money coming in every month or every quarter now from my work that I spent an hour doing 2 years ago. Right. So that's passive income. Passive income is when you have money coming in and you're not working for that money. So when it comes to real estate and lending, and especially the private money club, there's so many different ways I can passively invest. There's so many different options for lending. What do you enjoy doing? Like personally for me right now, I would not lend on a deal that's like a multi-million-dollar house flip. That's going to take a year to do, because if the market turns, the profit in that deal could fall out very, very quickly. So things can happen. So to me, I want affordable housing right now. I want quick flips. I want to put my money and get it back quickly. Or I want to do it in a development where, like with Rob, where it's already pre-sold to a big hedge fund or something with Jack, where I know the market that they're building in, and I know that it's in huge demand, and that demand's still going to be there in a year from now. I know it is because I know this market. Or I want to invest in somebody like Dwight, where it's a long-term play, where the cash flow is going to, the real estate market could drop by 40, 50, 60%, and Dwight's deals are still going to cash flow, which means I'm going to still cash flow passively because the money's there. So all these little things like that are things that we want to look at when we're lenders. And depending on what the market's doing, depending on what's going on in the economy, it's going to help me determine what kinds of projects and who I want to lend to when the time is right. But that's the beauty of it, is we have those options. We're not locked into one way or in one way only. We can lend it however we want, whenever we want. So it gives you a lot of different ways to do it right there. So hopefully, Carol, that answers your question. Jessica said, is it best to lend the money from an LLC before you lend in a private money club, or straight from your infinite banking policy? So Jessica, the only reason you lend from an LLC maybe is for maybe some asset protection reasons or tax purposes, but there's no reason you have to. So people lend all the time from their personal accounts. You can lend, from your IBC, just right to the segregated account. And then from there, you can wire the money to wherever it needs to go immediately. So no reason to run it through an LLC unless you want to, but work with your accountant, your estate planning professional on that, but there's no legal reason why you would need to. Now, you do need to always legally only lend to LLCs or corporate or companies, never lend to an individual, but you can lend from as an individual.
Maybe a couple of questions. It looks like Mark asked, how do I track all those transactions, accounts, and transfers, et cetera? So I started off actually doing it myself. And I think you can do that once, if you've only got a couple things going on, a couple properties. But once I got to a point where I've got a lot of them and a lot of different policies and all that, it becomes too much to juggle. So I have a really good bookkeeper who just keeps all that tidy for me. So I think it's really important. It's like whenever you have a good team, right? You got to pay for a team. Like a bookkeeper costs money, but cool thing is the cost for the bookkeeper is a tax write-off. So helps me pay less taxes and just keeps everything in line so I don't have to do it.
I love it. So, a lot of what we've talked about today has been based around using the infinite banking concept and especially design policies. One of the drawbacks on those policies are you cannot use what's called qualified money to fund the policies or run qualified money through policies. So I just wanted to kind of bring that up real fast. So when we're looking at where our money is housed and money that we're lending out, there's typically maybe 4 different buckets of where your money can be. So what I mean by that is there's a cash bucket. So that's going to be at like a traditional bank in your checking account or your business account, something like that. And then the second bucket might be lines of credit. So if you have like a HELOC, like you were talking about earlier, Devin, where you have all that equity in your home, you tap into that equity and you use that equity to put your money to work to make more money, right? So maybe some of your money's coming from that HELOC. What you're doing with a line of credit is leverage. And so we're leveraging what we already have into more. And that's one of the other beautiful things. Somebody mentioned that in the comments earlier, leverage. That's one of the beautiful things about real estate is I can leverage either my assets or my cash to obtain a lot more assets or cash. And the way we do that is just as a simple example, you guys were talking about a 3.5 down FHA loan earlier. I mean, I can go buy a $100,000 house right now that I want to flip for $3,500 down, leverage that $3,500 into 100,000 and sell that for 130,000 and make 30 grand off my 3,500. So that's what leverage is. So we're able to leverage cash. We're able to leverage the equity that we have through lines of credits and things like that. And then the other 2 buckets are going to be taking advantage of laws that are on the books. So number 1, we have retirement accounts. So 401ks, IRAs, SEPs, simples, things like that. Most people don't understand this, but you can take control of those retirement accounts and do what's called self-directed investing. So we work a lot with Horizon Trust Company to create these self-directed retirement accounts, but all that's doing is moving your retirement money from one place where it is now over to another place where you can control it. There's no taxes, there's no penalties for doing that, but you now have control of your retirement funds, and now you can lend them to Devin. You can go buy real estate, you can do rentals and things with your retirement funds. And the reason why you might want to do that is because you have an old 401k with a bunch of money in it. And if you pull that money out now, you're going to have to pay taxes and penalties and stuff. So maybe you just want to roll that over and control it and grow it in a way that you can control. But all we're doing with that bucket, those qualified funds, is we're taking advantage of tax laws. So the government tells us if we put money, for example, into a Roth IRA, that money is going to sit in that Roth IRA and grow through our investments completely tax-free. So if I have $100,000 in a Roth IRA and I make some good investments and I grow that to $1 million, I will never pay taxes on $900,000 of profit. So all we're doing is taking advantage. Again, when it looks to the wealth killers, inflation, volatility, and taxes are the top 3 wealth killers. So we're just eliminating the tax portion of those 3 wealth killers and taking advantage of qualified funds. And then the 4th bucket, the 4th and final bucket of where our money typically is. So we have the cash, we have the equity, home lines of credit, we have the retirement accounts. And then this 4th bucket is going to be our infinite banking policies. And again, the reason we run money through there is to take advantage of uninterrupted compounding returns, tax-free growth, and guaranteed growth within that policy. And the only reason we're able to do that is because of IRS rules and regulations, and the government allows us to do that as well. So whether it's Devin, whether it's me, whether it's any of you that are watching right now, we all have cash. Like that's what our money is. Whether you're trading your cash for real estate, whether you're trading your cash for precious metals, whether you're trading your cash for crypto, whether you're trading your cash for stocks, whatever it is, at the end of the day, it starts with that cash, right? So where is your cash coming from? Where is your cash running through? And then what types of investments is that cash going into? And that's what these 3-day events, these live training events and trainings, money school trainings that we do, this is what it's all about, is looking at where are you right now? What different areas can you take advantage of and run your money through, and different investments you can make to build that wealth and create more and more success, financial success for you and your family. So at the end of the day, it kind of boils down to that. It's not hard, but you're being introduced to a lot of new concepts and new strategies that maybe you weren't taught in college, you weren't taught at your corporate job, you weren't taught from your friends and family because they had never learned it. So that's why, I've dedicated the last 14 years of my life, 15 years of my life to financial education, to studying this stuff, to going out there, learning it, implementing it, doing it, and then teaching it. And Devin, I know you do very, very similar thing as far as everything you teach is stuff that you're already doing, right?
Right. One thing I would definitely stress to you guys is, like, you could learn everything unless you take action. It's not going to do anything. Like, I could literally give you all the knowledge I have in my brain. Stephen can give you all of his, but unless you take action and like use it, it's not going to do anything for you. So I would just urge you, when you learn something new, really study it, really understand it and learn it, and then use it. But probably the most important thing is, once you use it and you see success doing it, pay it forward, teach other people. I can't explain to you guys how much my income, my net worth has jumped since I started giving back all of my knowledge, teaching other people what I'm doing and what's provided me success, provided me cash flow. Once I started doing that, things took off like crazy. So give back your knowledge once you learn it, and once you actually implement it, just give to other people. Give, and you will receive more, period.
So these are the different places where money sits, right? And all these places, like this is a terrible place. So let's just draw that. This right now, you're not so happy about because that's been losing money. This right here, your broker said, don't worry about it. Stay the course. It's only a paper loss. Yeah, good. This one, you're probably pretty happy because every day it's worth more. This one, you're just confused as to what the hell you got to do. And over here, you're happy because, hey, you got equity in your house.
Yeah, and there's one more, Chris. So lines of credit, outside of even a HELOC, there's a lot of other lines of credit I've been hearing people talk about, and those are a big sad face because they open those lines of credit at 1.5%, 2%, and now they're up to 7% and 8%. So they've really quadrupled in many cases of people I've talked to lately.
So if we've got all this money sitting here, the things that we really need to hone in on and focus in on probably would be the ones that are losing, right? So we want to set priorities on which ones are actually losing money or have the potential to really, drop in value or lose value or cost more. So if we did that, it would be 401ks. Okay, that's hot. That's a hot topic right there. Your brokerage accounts or your mutual fund accounts, whatever. The equity, because you're worried, okay, if I don't get it now, it's use it or lose it. Same thing with your lines of credit, because both of these are going up in cost, but that's okay. These are the different things that we need to focus on. As you all know, we often talk about changing one thing. So if we really just kind of come over here, and I'm just going to do a different color, and we say, what ones can we focus on that we can make a big difference? I mean, you can make changes in these ones that are red, but what ones can we really make a massive change in? I would say would be those: your savings, just that money sitting idle, the money under your mattress, the equity in your house. We could probably say lines of credit, but I'm going to leave those out of this mix. And what we always talk about is we talk about where that money can go, and that being changing one thing, right? So this is the one change. And this is such a great time to have this discussion, because when we talk about specially designed and engineered whole life, and I want to preface that, specially designed, because every time we say this, there's always somebody that says, oh, I had my agent or my advisor look at this and they said, there's no way that's possible. Specially designed and engineered whole life. What do I mean by that? I mean, I'm not talking about a regular whole life. I'm not talking about the whole life that you bought 4 years ago from State Farm or Allstate or whatever company you bought it from. I'm literally talking about designing this whole life policy to work very different than life insurance. Very, very different. I'm literally taking it and I'm reducing the death benefit significantly. That's part of the engineering. I'm putting the death benefit at the lowest, which doesn't that sound backwards? Wait, I'm buying a life insurance policy that Dave Ramsey said is a terrible place to put money, but yet we're going to put the lowest death benefit on it. Wouldn't I want the highest death benefit? Yeah, if you wanted to protect your family and you were looking for true protection. But what we're looking for is we want a place for our money to go for banking. Okay, that's what we want, and that's all we teach, banking. There's two businesses in the world, says R. Nelson Nash, that you should be in. Number one, the business that pays your bills. Pretty important, right? If you can't put food on the table, pay your mortgage or rent, or provide shelter for your family, like nothing else matters. So your place where you derive an income to pay for your expenses. And the second business every one of you need to be in is the business of banking. Why? Because it's the fundamental. And if you can understand banking, you can understand control, and you can understand how your money needs to work, because banks have figured it out. For hundreds of years, they've figured this out. So when we design this, we put the lowest death benefit, and then what we want is the highest cash value. So how we do that is we just stuff a whole bunch of cash, a whole bunch of money from these different sources into this whole life. But then we put the lowest death benefit, because death benefit equals cost. I want to be very clear about that. When Dave Ramsey says whole life is expensive, the reason for it is the fundamental base of the death benefit is costly. That's where your costs are. In a whole life contract, really, there's cost of insurance and a policy service fee. In an IUL, don't even get me started, because we'll be here for 3 hours just explaining all the different costs that you have to pay. So we are not talking about IULs. We are only talking about specially designed and engineered whole life. So the cost, we want the cost to be the lowest amount. So some people would say, well, why don't you put the death benefit at zero? Because it's not allowed. The IRS has figured this out. So we have to play within the IRS MEC 7 pay rule. And that's the rule that we have to do. So we'll just say, IRS, you don't want to mess with them. If you want this entire machine, this entire whole life to remain tax-free, then we must make sure that under IRS standards, this thing is viewed as a life insurance contract. And in order to do that, I don't know any life insurance that doesn't have a death benefit. So we got to have a death benefit, but the IRS never says that we have to have all the death benefit be made up of whole life. We can actually make a large part of that death benefit Dave Ramsey's favorite thing, and we can use term insurance. Now, we don't always want to do this, but we can, and that would satisfy the IRS requirement. So we can construct and build this thing to be very efficient, is I guess the best word, very inexpensive and very efficient. And we'll show you some numbers in a second on what that looks like for any of you that have not seen what a specially designed whole life looks like. But I'm really just trying to get conceptual part out. So remember, we're changing one thing. That one change is where your savings, your lazy money, and maybe the equity that you don't have anywhere else for that money to go. IBC is already what we're talking about, so clearly that's in there. But your 401k, we want to keep, oh, shoot, I missed one, sorry. Definitely your brokerage account money. Although it's a priority, you might want to prioritize actually keeping that money in a brokerage. So you can see we got a lot of places to think about. We got their savings. We got our non-qualified brokerage account money, not IRAs, not 401ks, because that's qualified money. We don't want to pay taxes on money just by moving it. Your IBC is just a concept, lazy money and equity. All right, so that money comes in here. But then once it goes in here, we know a couple of things to be certain. Number one, you're going to get a guaranteed interest rate. And we can absolutely sit there and say guaranteed. Number two, you're going to get a dividend. These companies that we do are mutually owned. So every one of the insurance companies we use are giant mutually owned insurance companies. Therefore, all of them have paid dividends. And every single year they've been open, they've paid a dividend. It's kind of one of our criteria for picking an insurance company. We do not use mutually owned insurance companies that have not paid dividends or have a bad history of paying dividends. And there are some. The second thing, we want to build it within the MEC rules so that it's always going to remain tax-free. We certainly want to build it so that the cash value is the number one priority. And if that's not within what you want out of your whole life, well, then this is just not for you, because you're going to get it's not going to be very low, but you're going to get a lower death benefit and a higher cash value. That's our number one concern. The other thing we want to make sure is that it fits all the needs and goals. We want to make sure that how we design it fits your specific needs and your specific goals. And for a lot of the high net worth individuals that we work with, one of their big things is protection. This is a huge word, preserve and protect. Well, a lot of our wealthy clients right now, this is their number one objective. They want to protect what they have. They maybe have made enough. They have the money, and now they're just sick of losing it. They're sick of playing the game. So now they just want to preserve and protect. But in preserving, protecting, I would say a very close second to that, where they want that money ready to deploy. They want liquidity. So how do you have protection and liquidity in this same wrapper? Well, that's what I'm going to show you. But these are huge. And folks, I don't care who you are or what you're doing or what your goals are. these two should be very high, if not number one and number two, because in this time that we're going into with this economy, this slowdown, this economic recession looming or in it right now, depending on how you want to decide whether we're in a recession, you want to protect what you have, because I'll tell you, the one thing you don't want is you don't want to ride the roller coaster down and then have to fight for the next 5 to 7 years riding the roller coaster back up. That seems like an awful long period of time. I'm 45, so that would mean if I played the typical advisor's game and I kept my money invested and I just weathered the storm, or I rode it out, or whatever you want to call it, I literally am admitting that I'm okay with my money not being effective for me for the next 5 to 7 years. So that would mean I'd be 52 years old. My daughter, who is now 2.5, would be, let's say 5, 6, 7.5 years old. I'm not willing to give up that time. And if I'm not willing to give up that much time just to get my money back, well, then I better make some protection changes right now. And during those times, the other thing that I know from when Vivi's 2.5 to when she's going to be 7.5, that 5-year window, there's going to be a lot of opportunities, tons and tons of opportunities. And if I want to take advantage of opportunities, well, damn it, I need some liquidity. I need as much liquidity as I can get. So let's talk about liquidity back to these buckets. Does your 401k provide liquidity? Nope. Maybe up to 50,000 or 50%, but that's still got some strings attached. A lot of brokerage accounts, do they have ultimate liquidity? Because I know I bought, when I was an advisor, a non-qualified private REIT. It made a lot of sense, paid a good dividend, but I had no liquidity. That money is still tied up. Hopefully it goes for an IPO end of this year and I can get my money back and redeploy it, but you don't really have liquidity here. Maybe some brokerages. Line of credit, home equity line of credit. Yes, you have liquidity today, but maybe not tomorrow. So we want to make sure that we've got all these different things. If all these different things were important to you, guarantees, dividends, protection, liquidity, tax-free, well, then I don't quite understand why you wouldn't be considering a specially designed whole life, because it fits every one of those things. And a lot of people, they'll come up with their own ideas in their head from what they've learned and false things that they've been told, or maybe just things they've been told, which are true, but not in a general, like in a general context, they're true. Like Dave Ramsey says, whole life's the worst place you can put your money. Well, if you're talking about a regular whole life that has zero cash value in the first 2 to 3 years, well, then I would say that's probably definitely not a very good place, unless your sole goal is to make sure there's money that passes on when you die. But once we put the money in here and we're getting all that, the most important thing, and this is what screws people up, is we don't want to keep the money here. So let's just say we're making 5 to 6% with dividend. For some people, that's good. But for other people that say, well, wait a second, inflation right now is 7.7. So if you're making 5 to 6 and you're losing buying power of 7.7, which is, declining, is that suitable for you? For some people, they would say, well, it's better than the money in the bank. It's better than the money under my mattress. But Stephen, would that be suitable for you, knowing what you know, to earn 5 to 6 when inflation 7.7?
Not alone, right?
Yeah, right. So a lot of people out there, I'm not going to name our one main competitor, but they're pretty big and they got very boring YouTube videos that some people love. They love just selling you this. This is what they teach. They want you to buy this. They want you to say, oh yeah, this is 5 to 6%. It's better than your savings. Oh yeah, it's tax-free. Oh yeah, it protects you against judgments and liens. Oh yeah, there's a death benefit. But you see, we're on the other side. Like, I don't think what you need to learn is the product, but that's what you want to buy. Okay, because you think this is going to solve your problems. This is not going to solve your problems. You want to know what is going to solve your problem? What's next? And I'm going to draw over here opportunities. Another one of the things that we talked about was real estate or private lending. So private lending is by far my favorite right now. I'm not buying any real estate. And I'm not buying any real estate because I don't like to buy assets that I know are going to go down in value, even if they're going to pay me interest. Okay, so, or I'm sorry, pay me rents. Because I know that when I rent a property out, I've got a tenant, and that tenant's going to be more than likely a pain in my ass. I've only got one tenant that I can truly say isn't a pain, maybe two that aren't a pain in my ass. All the rest of them, in one way or the other, they're going to be a pain in my ass. Okay, they're going to need things. Something always breaks, and when something breaks, like you think you're doing really well from a cash flow standpoint, I could show you years and years and years of cash flow and net returns. It just takes one furnace going, one sewer backing up before that whole year's profits are gone. But you don't look at that. You're just looking at the cash flow coming in. Real estate is something I'm not doing, but private lending I like because I don't have to deal with any of the tenant problems. All I got to do is worry about, am I going to get my monthly check? And if that's the case, that's all I really care about. So private lending right now, most of the deals on Private Money Club are 12 to 15%. Somebody, I think, just posted a deal at 10% or asked me about posting a deal at 10. I said, nobody's going to bite on that. If inflation's 7.7 and you're only paying 10, and we think interest rates are going to go higher, like we're all of a sudden going to get squeezed. Because remember, I showed all those pockets of where money is. A lot of the lending money can come from a line of credit or a home equity line, but what's happening there? Interest rates are going up. So seems like every month you're paying more to use that money. So if your threshold on your money is 10% because you lent the money out for 12 months at 10%, well, then that gets pretty difficult to make a spread if your money costs more. But if you're doing it from your policy, it's game on. Even at 5.73%, if I'm lending it out, and actually my loans right now, because I use a line of credit, and you guys are going to laugh at me, I pay 6.5. Some of you are like, well, that's stupid. Why don't you just flip them back over to the insurance company? And I'll tell you why. Convenience. I pay 6.5. I just got a statement the other day, Coastal States Bank. This is what my CV line of credit is charging me, 6.5. But that extra, whatever that works out to be, 5.73 to 6.5, that difference, that extra that I'm paying is worth the convenience for me to have 9 policies all in one place in a checkbook. Cost is only an issue in the absence of value. The value to me is simplicity, and it allows me to move my money. Because I know I'm making 12 to 15. 6.5 minus 12 to 15 is a pretty good spread. And most of my policies are pretty mature. I got a couple that are in those first couple of years, but for the most part, I'm making a spread twice. I'm making a spread here, and I'm making a spread here. Follow what I'm saying? So I make a spread between what my money cost and what I'm earning. And I also make a spread over here on what my policy is paying me. Remember the numbers, don't get hung up on the 5 to 6, get hung up on what your policy is making in the given year that you're in. Because every year you're making more. Every year your policy is compounding uninterrupted, which means the compound interest. Does everybody understand compound interest? 1 year you got 100 grand and it makes 5%. Okay. The first year you made 5% on 100 grand. Okay. So you made $5,000. But the second year, you're making 5% on the 100 plus 5% on the 5 grand you made. You're making interest on interest. So then 105 is what you're compounding at 5. So you guys all understand that, right? What you probably don't understand is what that actually looks like over time. It's pretty freaking impressive. I mean, that's why Albert Einstein called it the 8th wonder of the world. But I'm making a spread. The cool part about this spread, this is why you always hear me teaching this spread. And some people don't like that. But the reason I always do is because I know for a fact, every year I make more. Every year this spread gets bigger. We just demonstrated. Every year, no matter what I do, no matter what happens in the economy, doesn't matter. I make a bigger spread each year just because of time. Over here, well, I can control the spread because I can go out and I can lend money, or I can do real estate deals that are going to pay me enough to make that spread bigger. So I guess I kind of control this, but it's not an automatic increase every year. Does everybody track with that? Well, Seth said something that's pretty good. In private lending, how do you get the same tax benefits? You don't. That's a big thing. So I do want to hit that. It's very important observation. So when you lend money, okay, when I lend, all of the interest that I'm making, the 12 to 15%, 100% taxable. And I got no deductions unless I'm lending out of an LLC, and then I can do corporate meetings, I can do all sorts of stuff and write it off, which is how I do it. But then up here, if you own real estate, if you buy rentals or do syndications or flip houses or whatever, you got forget flipping, you got depreciation. You can cost seg that. You can get a tax deduction for the depreciation. So if you're worried about taxes, this is definitely a good way to go. Okay, I'm not ever saying that buying real estate isn't the thing. You know, it's a great way to get wealthy. I just, right now, for me specifically, I'm not making a recommendation or suggestion. You do what you want to do. I love real estate, but I just want to lend to you right now because I just don't want to buy a piece of property that I know for a fact, no ifs, ands, or buts, is going to go down in value. That's just to me, not a logical business decision for me. Even if the rents are coming in, I got a 2.5-year-old. I don't have time to deal with tenants calling me, and freaking just this weekend, 3 phone calls, 3. just this weekend. I don't even have many rentals anymore. So it's like, that's a nuisance for me and I don't want to deal with. But for some of you, like, this is great. Buying real estate is great. But if you're buying real estate, chances are you need money. And guess what? I got some. And I got a lot of other people in Private Money Club that got a lot of money too. Mine's all taxable. So I'm not going to get into this, but my tax structure is set up in a complex trust. I've got all my LLCs, okay, same as what they are. There's, I think right now, 14 of them, I think we counted 14 or 15 LLCs. They all feed into an operating LLC. Okay, so then I got my operating LLC. Anything that operating LLC makes flows to a business trust. Then that business trust makes investments, does loans, buys whatever, investments it wants. Then from there, whatever I don't want in there flows to my family trust. And it's part of the complex trust structure. My family trust owns my house, pays for my house, pays for household expenses. Anything that's left by the end of the year, we write a check to our foundation, our 501c3. And that 501c3 now makes donations to charities. And I like kitty cats, so we donate money to this place, 10 Lives Club. I donate money to Wounded Warrior. I could show you my desk. I got a whole stack of places I donate money to, and it's all from the foundation. So I control my taxes by understanding the tax code. You control your taxes by understanding depreciation in the tax code. Point made, both are very valuable. Both are equally as beneficial. Can you get a tax deduction through putting money into your whole life? What Seth's asking is, can I get a tax deduction for putting money here? You can, but I wouldn't do it. I would advise heavily against that, because now you're taking and putting, you're taking the bait. You're getting a tax deduction today to pay taxes later. Okay. And I want my money in the future, the higher amount that it compounds to be tax-free, just like a Roth. I want to put after-tax dollars into this so that all my money is tax-free. If you take the bait and you get the tax deduction for the money going into the whole life, if you owned it with your company, what you're doing is you're foregoing the tax-free nature of the policy, unless you use trusts. I mean, inside of specific trust structures, you can kind of get around some of that. But again, I'm not here to teach you that today. I'm not a CPA. All right, so back to this. So now we have to decide what this opportunity is after debt's done. Maybe lending or real estate, both have admin, have things that you really, may seek and desire. But the other thing too that we need to do, whatever your real estate makes you and whatever your lending makes you, let's not forget that this money needs to be recaptured back to your bank, which your bank is the specially designed whole life. Anything your business, your real estate property does, or your lending goes back to your bank. Now, let me talk structure, okay? Because a lot of people are looking at that being like, well, sounds simple, but it doesn't really seem like it can be that simple. It's not. Well, it is, but it's not. So if you're going to buy real estate, chances are your real estate is going to be owned by an entity, right? Anyone on here buying their investment real estate personally? If you are, please raise your hand and say, yes, I've been buying all my rentals personally, because we need to have a really serious talk, because I'm going to go to your house and I'm going to slip and fall. And whatever your assets are, I'm going to sue you for them. I'm just joking, but I want you to think that way. If your properties, your investment properties are owned by you personally, you are literally hanging yourself out there for a massive issue. So most people don't own their real estate in anything other than an entity, LLC, S Corp. I don't care what your entity is, maybe trust. It's in a protected entity somehow. Okay. S Corps. So the real estate's in the entity. So now if this policy is owned by me personally, I own this personally, and I want to then send that money over to buy real estate. There's an extra step. And that extra step just is the same thing. So now I can kill two birds with one stone here. If you're going to lend or you're going to buy real estate, you're going to need to understand what a promissory note is. So I'm just going to write note. And all of you have an attorney, or you should get an attorney, specifically a real estate one. You should learn what a promissory note is. It's simple. Okay. It's I promise to pay back based on the terms. It's your terms. So if you own the policy and you want to buy real estate, but your entity is going to own the real estate, what you have to do is a note from you personally. So I don't know, who can I pick on here? Seth. We're going to pick on Seth. I, Seth, lend XYZ LLC $100,000. Sorry, need more room. At 6% for 36 months, and $2,000 a month is the payment. I'm making stuff up. So your promissory note spells out the terms. So you personally are lending money to your entity being XYZ or whatever it is, And in this entity is agreeing via this note, and the owner of the entity, you might have partners, each of you are going to sign. You're going to sign and your partner is going to sign, okay? You both signed, the borrower, which is the entity, signs the note. So now your policy lent money to your entity via a note. Now your company is then, and let's just use 6% as the number because that's less than what you can get a mortgage for. Your company is then going to make a monthly payment of $2,000 a month back to your policy. And some of you are like, well, wait a second, isn't that taxable? Yes. This $2,000, let's just say, represents all interest at 6%. That's all taxable. But to the company, to your entity, this $2,000 is a tax write-off, a tax deduction. Check with your CPA, but this would just be interest expense. So if this entity is a pass-through, like an LLC or an S Corp, well, this interest expense, it's basically neutral. This washes this. In a perfect world, your CPA would do this. You're taking a deduction on the entity side, but you're taking a taxable income here, a 1099 income here. But because this is pass-through, this should wash that. So really the economic benefit for doing this is you just picked up a very low risk way to make 6% because your entity is going to pay your policy back. So the same note would happen if I was going to lend XYZ. So let's just say we're going to get rid of the real estate because that's just a way to do that. Now, let's say I'm a third party on Private Money Club. Okay. So I'm one of the lenders on there, and Seth and his entity XYZ comes to me. We're going to get rid of this 6%. Sorry, Seth, that's not going to happen. Okay. Comes to me and says, hey, I need money for my deal. And I say, great. I'm going to charge 15%. Let's do 12. I'll be nice to Seth. I'm going to charge a 12% interest. And Seth agrees. What I'm going to do then is I'm going to move to have my attorney draft a note. I, Chris Noggle, the lender, or my entity that I'm lending from, is going to lend XYZ, Seth's company, we'll call it $400,000 at 12%. And I don't know, $4,000 a month is going to be the payment. Now, the extra step that I'm going to do here after Seth and his partner sign off and that now I got the note. Now what I'm going to do is I'm going to have an attorney draft a mortgage, and I'm going to tell Seth and his company, hey, listen, I'm going to be in first position. I'm going to have a first lien position on your property. So just so you know, if you don't pay me this $4,000, I'm going to take that pretty little property of yours. I'm going to foreclose on you. Seth says, no, that's never going to happen. We're going to make this. And that's what I want to hear. Seth's going to make a $4,000 a month payment to my policy, and that's secured to me by the mortgage. And also then I go to Seth and I say, hey, Seth, I need one other piece of paper. You got insurance on that property, right? Oh, yeah. Okay, Seth, well, what I want to do is I want to be named additionally insured. Either I talk to his insurance agent or he does, and they list me as additionally insured up to $400,000. Because you know what? If Seth's property burns down or gets hit by a hurricane or is no longer there, I don't want Seth to write me a check. Seth's kind of grieving. He's pissed. He just lost his property. I want the insurance company to write me a check. So the insurance company says, yeah, that damn hurricane. Sorry, Seth, your house is gone. Thank God you were not in one of those excluded flood areas, but you no longer have a house. So the insurance company is we're gonna reimburse you the what do they call it? Replacement cost. Oh, but Seth, this guy Chris Noggle is on your policy for $400,000. So we're going to pay him out first. First 400 is going to go to him because we don't want to lien on this property. So we're gonna pay that lien off, and then Seth, we're going to give you the rest to rebuild your property. So I protected myself against unforeseens. I protected myself against Seth not being a good borrower, and I laid out the terms. And now all of a sudden I've got myself a deal, and Seth is now making $4,000 a month payments. Now, what's the downside to me? $4,000 a month in taxable income. At the end of the year, Seth's company is going to 1099 me, saying, hey, we just paid you, I don't know, let's just say he pays me $30,000 over the course of whatever that is. I'm just making it up. That's taxable income. Then comes the trusts and all that good stuff. So does everybody understands that, right? So we went over 3 different things. We went over opportunities, and those opportunities for your policy. The money, and I want this to be clear. This is where the money always should start. Always. Your lazy savings, your money that you have, I don't care if it's your money in your company or your money personally. If you've got money that you keep in your savings account that exceeds 3 to 6 months of expenses, what are you thinking? Why are you helping the bank? I want to know something. If this is you, and please don't admit that you are this person, but if this is you, if you got hundreds of thousands or a bunch of money sitting in a savings account, why? The bank doesn't even send you a Christmas gift. They're not going to give you those little speakers, those wireless speakers at the end of the year. They're not even going to send you a thank you letter. None. And they're not paying you hardly anything because they don't have to, because they don't need your money. So why in the world would you just keep money in a savings account? There's only one answer. It's because it's what you've been told to do. Or maybe you're nervous now and you're like, well, I don't know, like it's guaranteed, which really it is up to 250,000, so they say. That would be a big no-no. If you got money in a brokerage account right now, what are you accomplishing? You making money? What are you investing in? You buying Apple, AT&T? Did you buy Netflix? Did you buy Meta when it went down? What are you trying to accomplish in here? Are you a professional stock trader? Because chances are any money that's in a brokerage account right now is losing money. Or maybe you've sold some of them, you just have that money sitting in a money market inside the brokerage. Again, why are you trying to help Wall Street? First you were helping the bank, and now you're trying to help Wall Street, and you're just giving them money to use. Why? Shift that money, change where that money goes. Take that money out of their hand and put it in your hands. Put it into your bank where you control it, where you're making an interest rate and have all the things that you wanted. Equity in your house. Why isn't that money out there working? I just was on the phone with a really dear friend of mine. He's in California. He tells me openly, he says, hey, Chris, I need your help. I got $1 million in equity sitting in this house and I don't know what to do. I said, have you heard of private money? Well, he knew about Private Money Club. He's like, you got to get me into this. You got to tell me how this works. I said, it's easy. It's like dating. You just go in there and you just look through deals. So I'm in here. I got an interest calculator. All right, I'm a lender at 12%. Here, let's actually get the number. Seth wanted 400 grand. I was going to lend it to him for 12 months. I don't lend any longer than 12. Holy crap. I thought I was right when I did the 4,000, but I was guessing. So I guess it's simple math. So, all right.
Just to teach on that real fast, you have to put 12 in that or else it won't work. So always put 12 in that second line.
Let's hear. I'm going to come in. I'm going to look at active listings. So this house just got posted. I don't know why they don't have photos up yet, but this one here is the one that I kind of liked. Single family house deal, an upcoming neighborhood I like it because it's Texas. Now you can see this looks like your typical flip. Total needed 218. I have a lot of questions. 2211, background, all this info. I can look the address up right here. I can actually put it right in house folios and I can research it and underwrite it. But I thought this was I just think Texas is a good place to invest. So you can see the map, you can get all the information, you can look at the financials on the property. But down here, she bought it for 158,000. Okay. So she bought it for 158, rehab and furnished, 60,000 ARV. Let's see, that's the ARV is 265, 60,000 rehab. So that's how she's arriving at this price. Would I lend 218 on this deal? No, I don't ever lend 100%. So I'd want to know how much Michelle is going to put into the deal. And if it was nothing, then I wouldn't lend, or I would just lend up to what I'm comfortable lending up to, which would be about 70% of the 218 or 200. I might use this, 70% of the ARV if I verify that number. This is a good deal. Okay, so I would look at that one. Let's see what other ones got a 12%. This is a really nice one. The only reason I don't like this one is it's 48 months. I'm not lending out 48 months, but for somebody that was interested in it, seeking a loan of 200,000 at 12% interest only for 48 months, second position. So 2 strikes. Number 1, 48 months. Number 2, second position. Not my cup of tea, but that's a nice looking house. Tennessee, good area too. Curtis, he's got a good deal, just doesn't fit my criteria. I tried lending on this one, but he already got it funded. So this particular deal I liked. I didn't like the way he did photos, but I did already kind of help him and give him some advice. So this deal I actually wanted to lend on. I was psyched about lending on it, but somebody beat me to the punch and lent on it first. So it was in Indiana, which is an area I do like, but it fit my criteria for everything I wanted. So, if you're looking for a deal, you just go on here and you can just browse through and you can just check out all the goods and all the deals. New deals are going up every day. Once I see photos on this, typically I won't even look at a deal, but I know this lender or this borrower. I've lent a lot of money to him over the years. He's paid back every loan. He's usually doing deals with Chris Rude, just to give you some context. But I've always loved his deals. He's very professional, very good at doing what he does. He'll have a whole packet. So if you ask him about this deal, he'll be able to send you an entire kit on this. He'll also send you his personal financial statements, which show all the real estate that he has. This one's in Louisiana, which is where he does most of his deals. So yeah, I'm just trying to give you just some of the opportunities that are in Private Money Club, but these are great opportunities that you can use. But again, stop keeping money in stupid places. Start reallocating money that has the potential to go down. Get it into a place where it's secured, guaranteed, and safe that gives you liquidity of that money, and then giddy up and go and find yourself an opportunity on where to move that money. I don't care if it's lending or buying real estate or notes or whatever it is you want to use the money for. Just control the spread. Just always control the spread. If it's debts that you have, focus on the debts. From all of us at our family to your family, enjoy yourselves, give a lot of hugs, show a lot of love. Talk to you soon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.